I have to get your take on what happened in the market yesterday. Huge outperformance not only in stocks, but what we saw in the bond market with rates falling dramatically. That has to have implications for real estate.
It sure does, and it goes to show that even early signs of recession perhaps being delayed or going back to the soft landing scenario, which people have given up hopes on because the Fed has been so aggressive on interest rate increases, can make a difference in the psychology and the confidence level of the investment community. For us in commercial real estate, the success of interest rate increases has really created a shock in that the math in underwriting commercial real estate, whether it's an apartment building, a shopping center, a hotel, makes a significant difference on the valuation because buyers are looking for a certain return. And compound that with the Fed's messaging regarding job growth, which they're hoping will turn negative in order for unemployment to go up, creates concerns about occupancies and rent growth. The combination of the two has really disrupted the valuation and the trading environment. But yesterday was a great example of what happens when interest rates just come in a little bit and the notion that the Fed will have to stay aggressive eases a little bit. And that's a foreteller of what happens in a few months when the inflation indicators start to really go down.
Yeah, let's see.
And all the capital that's in the market, this is a liquid real estate recession, if you will, in that there's liquidity, people have plenty of capital, and there's big demand for the sector. Unlike 08 or 09, when we had an illiquid environment.
Let's talk about retail. We're waiting for Walmart next week, but you've got such a great lens into the retail sector, just given your real estate footprint. What are you seeing? Tenants, leasing activity?
Ironically, retail, which was left for dead a few years ago from a brick and mortar perspective, has been the outperformer in the last 12 months, mainly because investors are coming in, reimagining older shopping centers, re-tenanting older shopping centers. And with the economy reopening, we're seeing a return to fitness, restaurants and bars and entertainment, bringing consumers back in with foot traffic. Foot traffic is at record levels.
Really?
Many of our shopping center clients are reporting leases that are being signed up and demand for leases by tenants, unlike anything they've seen well before the pandemic. So retail is really repositioning itself, and there's a rebirth of retail going on. The other segment of retail that's really interesting is the single-tenant long-term leases on like drugstores or auto parts stores, where there's a certain security of cash flows. Those have been in demand the entire time.
Cities that had the most opportunity or you're seeing strength right now would be what?
In the Western U.S., we really like what we see in Seattle, markets like Denver that are really dynamic. Obviously, Texas, Florida, the Sun Belt, Georgia, the Carolinas are all very, very strong demographic type of markets. But don't leave the urban markets for dead.
Right.
I've seen
New York is coming back.
New York is coming back. If you look at the apartment vacancies in New York, they've gone way back down. Office vacancy is a problem.
Right.
The office sector is really
not fully back yet.
Not yet. And that would be the sector that's hurting the most, not retail, ironically.
Interesting. Do you think office gets back to 100% at some point?
I think it will, because the next 2 to 3 years will be tough with the hybrid work environment.
Yeah.
After this recession concern and the Fed cycle, I think we have another growth cycle behind it, which should begin to create new demand for office space.